The world's big iron ore miners are in uncharted territory, having failed to settle on a price with Chinese steel mills. For their part, the Chinese say they'll continue to negotiate for a price below what the Japanese mills agreed to last month. Until then, rolling contracts will revert to the spot price, causing uncertainty and instability for the sector. Desley Coleman reports.
While negotiations have run up to the wire in the past, never before has the June 30 deadline been reached without agreement.
The annual benchmark system arose because going back a few years ago, the iron ore market was a lot thinner than it is today. Volumes were lower, prices were lower, margins for the producers were lower. So I think at that time the benchmark system suited the miners and also the steel producers as well.
But times have changed. While Japanese, Korean and Taiwanese steelmakers have locked in a 33% price cut, China's mills are holding out for more.
I think the Chinese negotiators have really painted themselves into a corner here by being so intransigent. I think they were probably somewhat surprised that the Japanese and the Koreans and the Europeans have settled at levels that they considered unacceptable.
And they could end up paying more if last year's prices are repeated. In 2008-09 financial year, the benchmark was $90 a tonne versus a spot price almost double that of $175. Since 2000, the spot market has been growing. Last year, it made up nearly 40% of all iron ore sales. There are conflicting views in the industry, with some analysts saying that the upside of an iron ore price driven by daily supply and demand will benefit producers. But others warn that a complete switch to a spot market price will damage the industry's stability.
It will introduce more volatility into volumes. It will introduce more volatility into the revenues of the companies and potentially erode some of those characteristics that have made iron ore such a great business to be in.
And Alan Heap says agreed prices usually deliver better outcomes for producers in the long term.
What I suspect it is, it's not the contract price per se, but the volume contracts that go along with that. Because if supply and demand are growing pretty much hand in hand, then volume contracts lock out new entrants.
But according to 20-year iron ore veteran Malcolm Randall, smaller players will also struggle if the spot market is dominant.
You are getting spot prices a lot lower than benchmark prices in the current markets, but I would be somewhat concerned as a junior producer in this current market, given the enormous amount of stockpiles being built up in China, and it definitely would tend to favour the buyers of iron ore over the short-term period.
The Chinese think that iron ore prices ought to be lower, but just because they think it ought to be lower does not necessarily mean that that is the market.
China's mills are banking on this and tonight are continuing a game of brinkmanship, saying they can hold out due to the large stockpiles they've built up in recent months.